A 5.00% APY savings account is not a wealth-building instrument. It is a psychologically engineered parking lot designed to feel productive while your capital quietly erodes against the one variable the marketing brochure never mentions. Right now, the average high-yield savings account rate offered by digital banks sits between 4.50% and 5.10% APY. That number feels significant. It feels like your money is working. But here is the structural reality. The Federal Reserve's terminal rate cycle has already peaked, and institutional economists at JP Morgan and Goldman Sachs both projects the Fed funds rate dropping to the 3.00–3.50% range by end of 2025. HYSA rates are not fixed instruments. They are floating, derivative, and entirely correlated to Fed policy. The moment the Fed cuts, your 5% becomes 3.8%, then 3.1%. You don't get a notification. The rate just quietly adjusts, and the fine print of your monthly statement. Meanwhile, a taxable brokerage account, invested in the low-cost Total Market Index Fund, specifically the Vanguard CRSP Total Market Index, has delivered a compound annual growth rate of 13.4% over the last decade. Not 5%, 13.4%. That asymmetry is not an accident. It is the foundational architecture of institutional wealth, and most high-earning professional women are sitting on the wrong side of it. Here is the math that your bank's UX team does not want displayed on a clean dashboard. Assume you are a VP-level corporate executive earning $140,000 annually. After maxing your 401k at $23,000 and covering core living expenses, you have approximately $24,000 in annual investable surplus. You park that in a high-yield savings account at 5% APY. At the end of year one, you have earned $1,200 in interest. Now apply your marginal federal income tax rate. At $140,000 gross, you are in the 24% bracket. The IRS taxes HYSA interest as ordinary income. Your $1,200 becomes $912 after federal tax alone. If you are in a high-tax state like California or New York, add another 13% in state income tax. Your effective post-tax yield on that HYSA drops to approximately 3.2%. The advertised 5% was never real. It was the pre-tax, pre-inflation, pre-fee gross figure. Now run the same $24,000 through a taxable brokerage account, indexed to the S&P 500, using a buy-and-hold strategy with zero active trading. Historical 10-year CAGR, 12.6%. Capital gains tax treatment on assets held longer than 12 months, 15% for income, between $89,250 and $553,850. For single filers in 2024. Not ordinary income tax. Not 24%. 15%. And that tax event is entirely within your control. You only trigger it when you sell. Your HYSA generates a taxable event every single calendar year, automatically, with zero input from you. This is the incentive structure asymmetry that institutions exploit. The tax code is not neutral. It was architecturally designed to reward capital ownership over capital hoarding, and the HYSA is the hoarding vehicle dressed in a premium interest rate costume. Now, compound the divergence over a 10-year horizon. That same $24,000 annual contribution into an HYSA at an effective post-tax yield of 3.2%, accounting for rate decay as the Fed eases, accumulates to approximately $284,000 over a decade. The same $24,000 annual contribution into a diversified index portfolio, at a conservative post-tax CAGR of 9.5%, after long-term capital gains treatment and fund expense ratios below 0.05%, accumulates to approximately $384,000. That is a $100,000 structural gap, built not by risk-taking, but by understanding which container your capital sits in. The $100,000 you left on the table isn't a market timing failure, it's a capital container selection failure. And here's where the pressure compounds specifically for high-earning women. The superwoman financial architecture is real and quantifiable. Research from the Financial Health Network shows that women at the director and VP level are disproportionately the primary financial underwriters of extended family systems, carrying household liquidity, supporting aging parents, and funding educational costs simultaneously. That role creates a visceral psychological demand for liquid, safe capital. The HYSA is not chosen because she doesn't understand markets. It is chosen because the emotional cost of illiquidity feels too high when you are the financial load-bearing wall of an entire household structure. The system monetizes that pressure. Every basis point of yield she sacrifices to feel liquid is margin captured by the institution holding her deposits and redeploying them into leveraged loan facilities, earning 8–12%. Here is the structural revelation that reframes the entire calculus. The financial industry has successfully conflated two entirely separate functions: capital preservation and capital growth. A high-yield savings account is a legitimate instrument, but only as a liquidity reserve, not an accumulation vehicle. The moment it exceeds 3 to 6 months of gross operating expenses and balance, every additional dollar parked there is experiencing what institutional analysts call yield compression drag. The compounding loss of real purchasing power when post-tax, inflation-adjusted returns fail to outpace the 3.4% core PCE deflator, which is the Federal Reserve's preferred inflation metric. At 3.2% effective HYSA yield against a 3.4% PCE deflator, you are not growing wealth. You are experiencing a negative real return, denominated in the psychological comfort of a rising nominal balance. The institutional-grade correction is a two-container capital architecture. Container 1. Maintain a defined liquidity threshold, 3 months of true operating expenses, hard cap, in the HYSA, not 6, not 12, 3. Container 2. Systematically route every dollar above that threshold into a taxable brokerage account, structured around low-cost, broad market index exposure, specifically funds with expense ratios below 0.10%, and execute a consistent dollar-cost averaging schedule without deviation. This is not aggressive investing. This is asset container optimization, and it is the exact capital architecture used by institutional endowments managing university and foundation portfolios globally. The additional lever is tax loss harvesting inside the brokerage account. When specific positions decline, you systematically realize the loss to offset capital gains elsewhere in the portfolio, reducing your effective tax rate on investment income. A Roth conversion ladder layered on top, converting pre-tax 401k assets during lower income years, further compresses your lifetime tax liability on accumulated wealth. The architectural integrity of your financial life cannot rest on an instrument whose yield is controlled by a committee meeting that happens 8 times a year without your input. You did not build a 6-figure career to have your capital strategy dictated by the Fed's dot plot projections. The two-container architecture returns allocation authority back to you. The painful irony is that even when a high-earning woman corrects her capital container strategy, the underlying income flowing into those containers is still being structurally taxed at a rate that systematically outpaces her male counterpart's effective burden. Not because of discrimination, but because of W-2 dependency. That income architecture failure is precisely what feeds the $200,000 salary, zero wealth equation. Click the video on your screen right now, and let's dissect exactly how a 6-figure W-2 salary structurally prevents wealth accumulation, and what the tax code is actually incentivizing instead.